information today, so I want to make sure that we give the full hour time period so that we can have time not only for all the great information but also for questions. So, hi, I'm Crystal Langholtz with First Nations Awista. I'm super excited to welcome you to Capitalization, Debt and Equity for CDFIs with Dr. Michael Swack presenting. This webinar will examine a range of capitalization strategies and sources of capital for Native CDFIs, including the pros and cons of each of those various sources. Potential sources of capital we will review include investment from banks, program-related investments, religious institutions, individuals, and government sources of capital. We thought this topic would certainly be helpful to you all in your pursuit of capital. This webinar is the third webinar in a monthly series as part of our Native CDFI Capital Access Initiative that some of you are participating in, which is funded by the Northwest Area Foundation. What's great about this webinar series is that all the topics discussed will focus on different ways to grow your capacity to access capital. To get us prepared, Stephanie will now share some information with you on the GoToWebinar platform, and we want to make sure that you know also that we will be recording this webinar, so you'll be able to revisit later on.
Awesome. Welcome, everyone, to the webinar. We are using the GoToWebinar platform, and throughout the presentation, if you have any questions, feel free to use the raise your hand feature, and I'll be happy to unmute you in the appropriate time. Or if you have a question that's really itching you, feel free to type it into the question box or the chat feature if you have that as well. Both areas, you're able to just type it in, and then we'll ask Dr. Swack at the appropriate time. So enjoy the presentation.
So thanks, Stephanie. So now we'd like to turn the webinar over to Dr. Michael Swack. He's a professor at the University of New Hampshire, where he has appointments at the Carsey School of Public Policy and the Paul College of Business and Economics. He's also the faculty director of the Center for Social Innovation and Finance. Dr. Swack has published in the areas of community development finance, community investment, and mission-related investment. Recent publications include a comprehensive industry analysis of the CDFI industry for the CDFI Fund and a book co-written with Charles Tansey entitled Capital Markets CDFIs and the Organizational Credit Risk. In 2000, he founded and continues to direct the Financial Innovations Roundtable, a program that promotes new approaches and policies designed to build the field of community development finance and increase access to capital for community development intermediaries. Dr. Swack received his doctorate from Columbia University, his master's degree from Harvard University, and his bachelor's degree from the University of Wisconsin-Madison. So that's super impressive. So that being said, it's my pleasure to introduce Michael Swack. Okay, Dr. Swack, we'll turn it over to you.
Great, thank you. I appreciate the introduction. And let me just switch to the next slide here. That's me, sort of. The thing to notice is the email address, because one of the things I mentioned is a lot of times people have questions, but they don't think of them until the next day or something comes up. And so I encourage you to email me if you have questions or thoughts that come up after the session today. I'd be happy to respond to you by email or to set up a phone call if that would be helpful. So I want to start, actually, Stephanie, I think you're going to help me with this, is to start by doing a brief poll by asking people on the call how many of you have a capitalization plan. So, Stephanie, do we have that? Yeah, if you could just select one. Do you currently have a capitalization plan? Before you vote, let me say a plan means that you have a specific amount of money you're trying to raise and a specific date you're trying to raise it by. So a plan that says we're trying to raise $5 million in new capital over the next 3 years, and then the plan maps out the different sources that you would approach and what you think you may be able to raise from each of those sources. So do you actually have a plan, something written down, an amount of money that you're trying to raise over a particular period of time? So let's just take 10 seconds for everybody to select one or the other. Okay, we have 23 people on the call. Has everybody voted yet, Stephanie?
We just have, I'll just give a few more seconds. We have 76% of the votes in. Okay.
All right. So, okay, yeah, this is, not too surprising about, well, there you see it, 41% actually have a plan. Congratulations, that's good for you. For the other 59%, one of the things I hope is that this session will encourage you to develop a specific plan, in part because I think it forces you to think about who the potential sources are. It gives you a challenge in terms of setting a goal that would be a challenging goal. And I find that it really helps CDFIs raise money when they think very specifically about how they're going to do it, who they're going to approach, and why they're going to approach them. So for today, having a little trouble getting this to move. Let me go over some the goals for the session. Essentially, I want you to get ideas for today. So one of the things I hope is that we'll cover a lot of material today, and you'll say, oh, there are a couple good ideas there in terms of what we would pursue. And I also want to raise some key issues that have been coming up in the field recently as with respect to raising capital, because there are some pretty new issues around opportunities and also constraints in terms of raising capital for the field. And obviously I want you to encourage you to develop a plan if you don't already have one. So those are the goals of the session, help you think about your needs and then how you might approach different sources. Here's some questions that I'll ask you to consider in terms of developing a capitalization plan. And we'll go over these questions over the next 45 minutes or so. And I'm not going to read any of these slides. You can read them. But essentially, I'm getting you to focus on what kind of capital do you need, why do you need it, who would you raise it from. So this is a series of questions that you might ask yourself as you're developing a capitalization plan. And I would emphasize at the bottom that a capital strategy fits your needs. There's no sort of standard issue capitalization plan that works for everyone. People on this call, each of your CDFIs will have different plans. You'll have different products, you have different geographies, so different sorts of issues and questions that you're trying to address. I'm going to stop also here for a minute to just reinforce what Crystal said earlier, which is I encourage you to ask questions along the way. I'll also leave time at the end, but often better to ask a question right when it comes up. And so I will look at the chat box, but also stop from time to time to ask if you have any particular questions. So please feel free. I really encourage it. So a plan. So this is what I said earlier when you voted. A plan starts with a goal. So how much are you trying to raise, over what period of time, and how do you break that down in terms of debt and equity? We'll get to those issues in just a moment. And do you have some sort of goal in terms of the debt, the blended rate? What's your cost of capital? What are you aiming for in terms of that rate? And obviously this will have an effect on raising funds for your operations as well. Let's start though by thinking a little bit about why you're raising capital, because often when you go to investors, whether they're institutional or individual investors, they'll want to know, what have you done so far, and what do you need new money for? Why are you raising money? And there are different reasons why you can. So for example, a lot of times CDFIs are raising money because you've run out of money. You're capital constrained. You've loaned out as much of your portfolio as you can, maintaining the liquidity reserves that you need. So there's just increased demand for funds. The second reason is that you're growing. You may be growing because you're expanding geographically. You're now going to be serving several other areas that you haven't. Or you're expanding. I've talked to a couple native CDFIs. They're now expanding to serve statewide. Or finally, there may be new products you're developing. You're currently offering housing loans. Now you want to offer small business or micro loans. And so by expanding your product mix, you need new capital to do that. In some instances, you may need different kinds of capital. You may need equity in order to begin to go into your small business lending program. So part of the plan starts with your goal, and then a clear rationale so you can explain to investors why you need this money and what that money looks like. Okay, let's move forward. I have here just a sample chart that shows how you might break it down. So if you're developing a plan, you might start by developing a chart like this, saying, well, we want to raise $5 million, so that was the initial plan. And here's some places where we might be able to raise some of that money. Here's some potential equity sources. Here's some potential debt sources. And what we want to do is go over many of these different potential sources so that you understand what are the benefits, the strengths and weaknesses of each of these types of sources. But as you can see, there are many different sources that you may approach. And one of the things that I want you to consider today is, are there certain opportunities to approach certain sources of capital that you haven't in the past? So for example, maybe you've never approached individual investors. And as I'll talk about in a few minutes, it may be worth considering, do you want to attract individual investors? Well, what are the strengths and weaknesses of doing that? But a good starting point is to sit down with board and staff and say, what are we trying to raise? What are the potential sources? And let's just get down on paper a chart like this that will help us think about the amounts and the different sources and how we might allocate those. Again, what are you raising money for? So we talked about the rationale for raising capital, expansion may be one. But also, key to raising capital is to know what you're raising money for. That's important because it addresses the issue of long-term versus short-term capital. So affordable housing, you might be looking for long-term capital. Small business and microenterprise, it might be short-term capital. You should be able to explain to any of your investors what you're raising money for, not just why you want to expand and raise more capital, but what specifically are you raising it for? What are the purposes, and ultimately, what are the products? And I mention this as well because there's a tie-in into how you capitalize yourself. Many CDFIs, for example, have to consider carefully that they may be limited in raising money that is short-term money. That is, you may raise money where you have to repay it in 2 to 3 years, but you're looking to lend money maybe for affordable housing in which you're lending long-term. One of the things I've seen more recently in working with a number of CDFIs is this whole issue of asset liability management. What do we do if most of our funds, if our blended funds are short-term, average 2.5 to 3 years, but increasingly the demand for funds, or we're trying to lend long-term? And so one of the questions often is it okay to lend to make long-term loans with short-term money? And the answer, as you might expect, is it depends. Typically, not a good idea. Many CDFIs now are actually, like banks, developing asset liability committees to actually look at it. And so it would depend on how much do you have in terms of capital that gives you flexibility. Are your investors likely to renew their investments every 3 years, but they just can't go longer than 3 years? Do you have potential new sources coming down the track? Have you negotiated, something we'll get into just a minute, a line of credit from a local bank that would give you access to capital and liquidity while you raise additional money if, in fact, you are trying to manage lending longer term with shorter term money? So there are a number of things that you can do to address asset liability mismatches, but the starting point is to try and raise money as best you can that fits the product need. So again, clarity in your capitalization plan about what you're raising money for will help you clarify when you talk to investors what you're asking them to invest, as many have flexibility. Let me stop for a minute and see if there are any questions there. Again, you can type it in the chat or raise hands. Okay, let's move forward and look at sources of capital. So here's just a list of different places you could look for money. We're going to talk a little bit about each of them. Some may be appropriate, others not, again, based on your history, track record, and the type of capital that you need. One warning is that I've seen several instances recently of over-dependence on one particular source, and this can be a problem. CDFI wants to be careful not to be too concentrated in one source, because if that one source goes away, then you've lost your ability to raise more money. And raise more money, this is true not just in terms of raising capital for your fund, but obviously in terms of operations as well. So you look at the list here, and again, we'll talk about banks, we'll talk a little bit about government, foundations, religious, and also private individuals. Star the private individuals, again, because I think that's where there may be opportunities where we're beginning to see a lot more growth in the field in terms of private individuals, although one needs to be careful, as we'll see, in terms of how you approach private individuals, making sure that you have the right documentation and don't run afoul of any securities laws. Let's start by looking at banks. First of all, the characteristics of bank lending is that there are two ways to think about banks when we look at characteristics. First is banks that may co-lend to your customers. That is, banks may be a source of funds not by directly investing in you, although clearly that is one source, but also banks are partner institutions that may co-invest with you in some of the loans that you'll make, particularly if you're making larger loans. Keeping in mind, though, as you see on the chart here, that banks like to make generally short-term, self-liquidating investments. They do debt and not equity. And also, you can run into variable interest rates with banks. And so, generally, the short term may not be the right product.
Dr. Sweck, we just had one question come up.
Okay.
From Eddie Edwards. He asked, FHLB system?
Yes, the Federal Home Loan Bank system, I think he's referring to. Yeah, that's a really good question. Let me defer that because I have a little piece later on about the Federal Home Loan Banks. And that's a really good question. The Federal Home Loan Banks, as many of you on this call probably know, now accept CDFIs as members. And as a member of the Federal Home Loan Bank system, there are regional banks. Being a member may give you access to a very low cost of funds, long-term loans. But there are some difficulties related to that, and I'll get to that in just a moment. So I will defer for now more on that, but I promise I'll get back to it. Other questions? So if banks offer generally short-term debt, why seek out banks? Well, we believe it's really important for CDFIs, for every CDFI to have a bank partner for one reason or another. And what I've done is put down 4 reasons here, 2 on this page and 2 on the next, as to why you might want to have a bank as a partner and why banks are an integral part of how you think of your own capitalization plan. So the first is liquidity. So if you are lending and you are getting more money out, which is a good thing, you may come up against a ratio, a liquidity ratio in terms of deployment ratios. So I'm not sure how many of you are familiar right off the top with what your own deployment rate is, but it varies quite a bit. I mean, we've seen CDFIs that have very low deployment rates, and just as a note of caution, when you apply for NACA funds or other funds from the CDFI fund, one of the things that the evaluators often look at is they'll say, let's look at the deployment rate of this CDFI. And often a CDFI will have an application that says, we're trying to raise money and here's our capitalization plan, but their deployment rate might be as low as 30 or 40%. What you should know is that in the evaluation phase, if you're going through the CDFI evaluation for CDFI funds, what's often true is the evaluators will look at that number and say, well, why do you need more money if you aren't lending out the money that you actually have? On the other hand, getting over 75 or 80% deployment, you may be running into problems where you need to maintain a liquidity reserve. You may be fully loaned out. You may be fully deployed. This number one here, the liquidity, having a line of credit from a bank is a really good tool to manage the ups and downs in your deployment rates. So number one, having a relationship with a bank, in this case having a line of credit negotiated with a bank, helps you manage the ups and downs of deployment. The second is leverage, trying to leverage. And let me talk about leverage more broadly as well. I think one of the key issues is that many CDFIs, and I actually saw this in the material, some of the people on this call, I got some of the background material from Awista in advance and was able to look at some of the financial information more broadly, is that there's sometimes a fear of leverage, meaning using your own capital to leverage debt like bank debt. And so the feeling is, well, we like to lend money we have, we don't like to borrow money. And yet again, this is something that often in the CDFI evaluation process, evaluators will look at. They'll say, generally, leverage is a good thing. You don't want to be over-leveraged, and obviously the amount you leverage depends on factors like how much equity do you have, what are your reserves, what's the nature of risk of your portfolio, is it high risk, are you likely to have higher losses than some other CDFIs, in which case you don't want to have a lot of borrowed money. But in many instances, the feeling is that CDFIs are under-leveraged, that is, they're lending their own money, the demand is high, but there's a wariness about raising money, debt capital from banks or other lenders, because in some instances CDFIs just don't like to do that. On the other hand, there often is good reason to leverage debt. If you have low delinquencies and defaults, if you have a track record of lending, if you have high demand for your loans, then developing leverage makes sense. Often people ask, well, what's the right ratio? What's the right leverage factor? And there really isn't one. It depends on the risk in your own portfolio. It depends on the appetite you and your board have for risk. But a good question to ask yourself as you develop a capitalization plan is, how much are we comfortable with in terms of leverage? And would we seek money from banks to meet that leverage requirement or that leverage amount that we'd be trying to raise? Let me go forward. Let me try to go forward. It takes a while to advance these, okay? Why seek banks, part 2. And again, a good reason to have a partnership with a bank is often they're able to provide a certain amount of expertise. Again, an example, I've been with a number of CDFIs where, for example, that asset liability management question has come up, where they said, well, how can we figure out when it's okay or how much it's okay to lend longer term when our investor money is shorter term? And again, this is an area where banks have a lot of expertise. Most of them have asset liability committees. This is an example of why a relationship would be good. And finally, having a relationship with a bank often positions you to refer your borrowers. And many CDFIs have relationships where they say, at a certain point, we would like to refer our business borrowers when they have demands for larger loans that we would make, or when we would like to graduate them, if that's one of the priorities of your CDFI is to help gain bank access. So having a prior relationship often leads to better opportunities for your customers to become customers of the bank later on if they choose. There are a number of bank-related programs. I'm just giving one example here, but there are also statewide programs of often consortia of banks that have partnerships with CDFIs, or in this case, the Goldman Sachs has 25 different CDFIs. They often take new ones that are doing small business lending where they provide training and access to capital to CDFIs. So this program is done through OFN, the Opportunity Finance Network. It's a national program. As I mentioned, there are also often statewide bank-related programs, meaning, for example, bank pools or special bank programs to serve CDFIs. Let me move on. Before I do, let me just pause for a moment again and to see if there are any questions that people have.
We had one question by Helen Scalia. She would like, she asked, Michael, can you speak to the differences between national banks and community banks when it comes to lending to CDFIs?
Oh, yeah, that's a good question. Thanks, Helen. Yeah, it's a hard question to answer. One of the concerns that we've really seen as relates to banks and CDFIs is that the banking sector is becoming more concentrated, and for CDFIs, that's generally a problem. What that means is fewer and fewer large banks, a small group of large banks, are controlling more and more of the banking assets in the system right now. And so what we've seen, for example, over the last 10 years is a lot of community banks going out of business, and those businesses being bought out and taken over by larger banks. By and large, community banks are generally more willing to make the kinds of loans that CDFIs make. And here's one of the ironies of that we sort of fumbled our way into when we were looking at a lot of the CDFI data that we looked at, which is that because there are fewer community banks, there's actually more CDFI lending in those communities where there had been community banks. And yet what those CDFIs find is they can't meet the demand. One of the problems we find is that the large banks, when they buy out community banks, typically are not as motivated to do lending in those local communities. So, for example, their small business lending portfolios, we've found, tend to tail off some. That puts a higher demand on CDFIs if there are CDFIs. The big national banks in general, Goldman is an example, but also JP Morgan Chase, Wells Fargo, Bank of America is a good example, are much more likely to want to lend directly to a CDFI than to lend to the borrowers you lend to. That is, for those big banks, it's much easier, their transaction costs are lower, to make loans to CDFIs to then lend to the end borrower as opposed to lending to the end borrower themselves. So, Helen, I would say that the difference you see is that the large banks, there's more motivation for a CDFI to have a relationship and borrow money from that bank because, by and large, those large banks don't make the types of loans that community banks made and still make in places where there are community banks. So I hope that answered your question. If not, you should let me know. Financing vehicles and tools. Let me talk about that briefly, and let me mention that. Yes.
So
yes.
One of the questions that came up was also from Eddie Edwards, and he was interested in Bank Enterprise Awards, and maybe we could take him off mute so he can further clarify that.
Well,
Eddie,
sure.
Any way you can do this way or that way, and the judge is like, Dan goes up, that case is not stare decisis in this district.
Fine, we'll come back to him if he. But he was. Is there anything regarding Bank Enterprise Awards that you feel comfortable addressing?
There's not much to say. I mean, the Bank Enterprise Award is still part of the overall CDFI fund program. And typically on the Bank Enterprise Act, it's actually a good question. It is a CDFI will approach a bank with an idea, and without getting too much into the Bank Enterprise Act program, but will say, we can apply for funds under the Bank Enterprise Act part of the CDFI fund. And the way that works is the bank applies for funds and then would apply it to the types of loans or to the CDFI itself in terms of providing that resource or using that subsidy that they would receive from the CDFI fund to help finance different loans or a particular program offered by a CDFI. And those awards, the advice I would give is you first go to a bank. Most of them are not aware of what the bank enterprise awards are, and so you would talk to them about what BEA is. They'll probably ask you to do the application for them, which is okay. Again, those awards are ones that you can help shape what they look like. The bank gets the award, but typically the bank passes on the value of the subsidy to the CDFI and or its borrowers. So it's a good question and worth looking into. Let me get back, if I can now, to the Federal Home Loan Bank question. This is probably a good place to put it. The Federal Home Loan Bank is both an opportunity and in some ways a problem. If you become, so about 5 years ago in 2010, regulations around the Federal Home Loan Bank, which is regulated by the Federal Home Finance Board in Washington, changed to allow the Federal Home Loan Bank system to enroll as members non-depository CDFIs, meaning essentially loan funds. CDFIs that were banks or credit unions were already eligible, but they now opened it to this big pool of CDFI loan funds. And what that allows, if you become a member, is that the Federal Home Loan Bank lends in the form of what they call advances to their members, which can be up to 20 years long at very low rates because the Federal Home Loan Bank raises money in the capital markets by selling bonds, and those bonds are AAA rated. And so they pass that on in terms of access to capital to their members. Sounds great, right? Long-term, fixed-rate financing at very favorable terms. Here's the problem that CDFIs have run into. In order to become a member, you have to pledge specific collateral. So, for example, typically, members of the Federal Home Loan Bank system historically were savings and loans lenders who made mortgage loans. And so what they would do is pledge the collateral of the mortgages. They would underwrite to a certain standard, and they would pledge the mortgages they made as collateral against those advances. Many CDFIs don't have that kind of collateral. They may, if they're making many aren't making loans for single-family housing, which is the primary purpose, and many that are making loans for single-family housing aren't necessarily underwriting in the same way, may not even be taking a first position in the loan. And so their collateral don't meet the standards of the bank. So one of the problems that CDFIs have run into is a number have become members, very few have actually been able to borrow because they haven't been able to meet that collateral requirement. But there's still another problem too which you might think about, and there are different efforts to address this. I think Susan Hammond is on this call. She's been part of an effort in Maine that's looked into getting access to CDFIs. And that is that by asking you to set aside specific collateral, they're also setting themselves aside as a lender with priority perhaps over your other lenders. Most, not all, but most CDFIs are pledging essentially all of their loans pooled as collateral. So they're unsecured. No investor in a CDFI has specific security. They have the overall security of the whole pool. And in fact, if you start pledging specific security to certain investors, it means, in a sense, you're disadvantaging the others. So this concept of pari passu, which means everybody shares and would get, if there were losses, proportional losses assigned to them. If you start giving special privilege to certain investors, like the Federal Home Loan Bank, which wants its own collateral, then in a sense your other investors are disadvantaged because it says you no longer share equally, there's this other one above you. The bond program, the CDFI bond program, has the same problem. That is, they want you to pledge specific collateral, meaning the government wants priority, if you have problems, over your other investors. So this is a real challenge for many funds because the question is, do you really want to give priority to a Federal Home Loan Bank or to the federal government in order to get the type of money you want but what will your other investors say? And you'll have to tell them this, and you may get feedback saying, well, that's not what you told us in the beginning. So this is the issue. Potentially good sources from the Federal Home Loan Bank, but potentially trade-offs that you have to make. A couple other things on this page. Loan sales, that's the idea of if you're fully loaned out. There are instances here where you can sell your loans to a third party. Here are 3 examples, and that gives you more liquidity. So by selling your loans, you're selling your promissory notes, your pieces of paper where people are promising to pay you. In exchange, you're getting cash for that to re-lend. One caution if you're selling your loans. For many CDFIs, that's your earnings. Your spread between your cost of funds and your loans is how you earn some money. If you're selling off your return, you're selling off some of your operating income as well. So loan sales gives you liquidity, but the trade-off is often you're trading off income. So let me pause again for a moment there, because that was a lot of stuff in the last few minutes in terms of the Federal Home Loan Bank and the bond program and the rest. Any questions? All right, let me try and advance this. Okay, I want to get a little bit into what's called alternative sources of debt or financing, meaning sort of non-bank. By alternative, I just mean institutions that aren't typically financial institutions, but make investments in CDFIs. So a couple of examples of that are the program-related investments from foundations, a whole bunch of institutional investors and individual investors, so religious organizations and universities, again, institutions that aren't typically financial institutions but have investment portfolios and do invest in CDFIs. And so the question is, are there these types of institutions that would be interested in you, either by nature of the fact that serve a certain geographic area, that you serve a specific Native American population? What is the mission of these investors who do this investment, and does it align with who you serve and what your mission is? So there are a number of possibilities here, and I want to take a few minutes to talk about each of those. The first is the program-related investments. Many of you are probably familiar with these, but again, more and more foundations are beginning to do this. In the past, it was only the big national foundations that started out doing this. The Fords and the MacArthurs and the Heron Foundation has been doing it for a while. But increasingly, and this is a good trend, community foundations and regional foundations are starting to do that. We've worked with a number of them over the past couple of years that have said, we'd like to support CDFIs in our region, in the community that our foundation serves. We haven't done this before. How can we figure it out? And many are. So a program-related investment is an investment that essentially their foundations are allowed to make through their IRS designation that allows them to make loans and to investments that are consistent with their overall program activities. So their primary purpose is to accomplish one of the foundation's goals. And like I said, national foundations have been doing this for a while. Some regional and community foundations have, and increasingly we're seeing more of this. So in your capitalization plan, you might identify or try to identify, are there local foundations that would be interested in investing in what we do? What I've listed here is some examples of typical program-related investments, that is, investments that charitable foundations have made in CDFIs or in CDFI-related types of investments. And so you'll see here they range from housing to small business to facility types of loans and are really can be pretty broad. So I would encourage you, as you develop your capitalization plan, to look at who are the local foundations. Are they familiar? One of the things I'd recommend is to set up meetings if you haven't already, or if you have a relationship with a foundation, to call the person and simply explain, if they haven't done a PRI, what you're doing, and inquire with them as to whether they would consider making a program-related investment and what they feel they would need to know and understand in order to make a program-related investment, either generally if they haven't done it before or specifically in your CDFI. I know we're going quickly, and I know we're going to do another webinar in a couple months where we're going to drill down and go into much more detail on PRIs, for example. So moving on for now, there are a number of federal programs. You're probably familiar with many of them, certainly the CDFI fund, the NACA program, but there are others as well that are relatively new. It's relatively recently that the SBA has established the Community Advantage Program, a program for CDFIs to be making small business lending. Many of you already utilize the U.S. Department of Agriculture lending programs. I mentioned the bond guarantee program. Again, the bond program, the challenge there is pledging collateral, and also it's difficult for smaller CDFIs, but you should know for the first time this year, OFN, the Opportunity Finance Network, put together a group of smaller CDFIs into a collaborative that successfully applied for bond guarantee funds. And so that's something that you might consider, that WISTA might be able to organize in the future in terms of accessing that particular federal program, again, administered by the CDFI fund. So if you aren't familiar with any of these programs, you should look into them. Again, whether you use them will depend on the type of lending you do. Obviously, you have to be doing small business lending to qualify for the SBA program, and specific requirements around USDA in terms of geography and population served. I've been talking mainly about debt, but I also want to at least touch on the issue of raising equity. For many CDFIs, this is actually the bigger problem, which is what happens when we actually do leverage our funds and we raise more debt. We finally get to the point where we have a problem with our capital ratios, meaning you can't raise any more debt until you raise more equity. That is the problem of potentially becoming over-leveraged. And there are CDFIs that are in that position right now. That is, they can't raise more debt until they raise more equity. And this is a problem, particularly most CDFIs, not all, but I think most, and probably most on this call, are organized as nonprofit tax-exempt organizations. That means you can't raise equity in the typical fashion of selling stock and finding investors who will invest in the company. If you are, there may be possibilities in terms of new crowdfunding. I've talked with a number of CDFIs. The regulations have finally come out, and the idea is, can you find individual investors? Again, in the crowdfunding on equity side, that would be if you're a for-profit. And the nonprofit, you're often limited to grants to raise equity or retained earnings, or in some instances this concept of secondary capital, or what we call EQ2s. And let me just tell you briefly about what an EQ2 is. Which I'll do as soon as I can advance this slide. Okay. So an EQ2 is an investment typically made by a bank, and essentially what it is very long-term, fully subordinated debt. So that means it looks like equity, although in your balance sheet it's usually an asterisk. I mean, it has to be counted as debt, but it's long-term, deeply subordinated debt. So in your audit, often what you'll see, an EQ2 will have its own footnote in which it says if there are any problems and claims on the fund, all the other investors would come before you. All the other investors would be secured ahead of an EQ2. So EQ2 serves as an equity type, but in the long run, meaning often in 20 years, this is money that is ultimately repaid. And the rates are then typically very low and over a period of time. So it's a product designed for nonprofits that's intended to have some of the qualities of equity, meaning it can help leverage other debt, and meaning that other debt would be honored before the EQ2 in the case of any dissolution, but ultimately it counts as debt, and that would be explained on the balance sheet. I want to raise the question as we talk about balance sheets of ERIS. If those of you on the call are not familiar with it, ERIS is the CDFI's ratings agency, essentially. They come in and they do a rating as a Standard & Poor's would, except that they focus exclusively on CDFIs. And I suggest this because ERIS says that the ERIS evaluations, and I've been part of them, are very thorough, very good, and often very informative to CDFIs in terms of helping them understand best practices and management practices. And also they give you a rating that serves as information that can go to investors who want to know who's a third party who's looked carefully at the financial and organizational management practices of a CDFI. And so it serves as a third-party due diligence that often encourages investors who wouldn't otherwise know how to evaluate you to invest. So ERIS is a rating process that you would go through. They come and occupy your offices for a few days and look at your files. In some ways it is a form of audit, and in the end you get a rating and also a lot of good information about how to improve your practices. So I recommend, if you aren't familiar with ERIS, that you look into it and the possibility of getting rated if you haven't already, as many CDFIs have found this to be a very useful process.
We had a few questions, Dr. Sweck.
Good. Let's take the questions in.
One person asked, please elaborate upon the Healthy Foods Financing Initiative.
Sure.
How to access the funds for this.
Yeah, the Healthy Foods Financing Initiative, again, is a specific initiative of the CDFI fund. So if you go to their webpage, these are funds that you would apply for separately from their other programs, and again are specifically designed to finance programs of CDFIs that are focused on broadly food-related. So for example, it can be to help establish farmers markets, it can be to finance food co-ops, it can be to finance business loans that are specifically related to producing healthy foods. So defined broadly, the Healthy Foods Initiative are CDFI funds that are set aside specifically for that purpose that you apply for separately from other CDFI programs, and that can be used for a variety of food-related projects and ventures.
Okay, and we had one question. In your research, have you determined the minimum efficient size for a CDFI?
Yeah, that's a great question and a really hard one to answer. You know, in our research, what we found is it's difficult to be small and generate sufficient revenue to be self-sustaining. And I think there are, a lot of issues. We're going to spend some time in a future session, and one of the things that we've talked to Heather at OISTA about are how can you build greater efficiencies? What are the collaboration opportunities for smaller CDFIs? What we found is that typically until you're over the $50 million mark, it's very difficult to generate substantial amounts of revenue to cover a significant amount of your operating costs. Now let me be cautious there in terms of what I'm saying about small CDFIs. Small CDFIs perform well. That is, when we looked at small CDFIs and compared to large CDFIs generated more revenue, they generally had higher deployment rates, generally had better performance measures, but small CDFIs did a very good job of making loans that were repaid. That is, small CDFIs are just about as good as large CDFIs in terms of serving unserved populations and managing risk in a way that that they have very low losses and repay their investors. So the challenge to CDFIs, smaller CDFIs, isn't, how do we do a better job? I mean, that's a challenge for every CDFI, but it's more how do we create greater efficiencies so we aren't so dependent on raising large amounts of operating capital from year to year. I know the unfortunate part, and I know it's true of some of the people on this call, is, if you miss a year of NACA funding, you're scrambling to figure out how you're going to get by that year. That operating a subsidy is really important in terms of helping you do your job. And so, one of the questions I think that we need to pose is how do we, as a group of CDFIs, smaller CDFIs, native CDFIs, begin to think about the sorts of collaborations on the operating side to increase our efficiencies, to diversify our funding sources, because it's hard for an individual CDFI that's in a remote area to raise funds nationally. And so I think it's important to begin to think about how do smaller CDFIs, particularly smaller native CDFIs, collaborate in a way that creates efficiencies for all of them. So that may be more than what you were looking for, but.
Great. We also we had a question come up about ERIS, and before I pose it, I wanted to let you all know that one of our webinars will be about the ERIS rating process. So I just wanted to give you a heads up there that we will get really nitty-gritty and detailed for you in that webinar. But the question that was posed here, is there a fee for the ERIS rating, and how much?
Yeah, well, yes, there is a fee, and actually one of the impediments that CDFIs often cite is that it's expensive, and there isn't a set fee. It's pegged to the size of the CDFI, and off the top of my head, I couldn't give you an exact range, but I think even for the smallest ones, it starts at roughly $5,000 and goes up from there. So again, it's an expense that you have to cover. It's not free, but again, often worth it. And if you're applying for funds from a local foundation, often makes sense to include the cost of the ERIS rating as part of what you're raising funds for. But yeah, it does cost money. Other questions? All right, let's wrap up then. We're getting back to well, what is your plan? So again, having gone through a set of various sources, encouraging you, we know 60% of you don't have a written plan. I'd really encourage you to start and develop a specific plan where you set an amount that you're trying to raise over a period of time, and where you begin to identify potential sources and then begin to research and meet with and try and access funds from those various sources, whether it's banks or PRIs or EQ2s or individual investors, where you might set up a program where you go after individual investors and have what's called a notes program, where essentially you're giving them promissory notes in exchange. They're just lending you money just like any other investor. You need to make sure, again, that you're in compliance with any securities laws, but individual investors are a potential source. So what are your most appropriate sources of debt given what you lend for and your location? What are your most appropriate sources of equity? Who could invest? And again, developing a reasonable timeline. Again, this is the chart I had at the beginning as a starting point, just to write down potential sources and amounts you might raise and any notes. And again, in the notes, a lot of times the starting point is your board. Is your board connected to specific religious institutions or foundations or any other types of organizations that have investment pools? Can they make an introduction? Can you begin to set appointments, talk to people about what you do, and begin to pursue investments perhaps from sources that you haven't before? So again, strong encouragement that if you don't have a plan, to develop one. If you do have a plan, to think about some of the additional sources, perhaps extend and revise your plan. And we're just about at the end, but have a few minutes left if there are any last questions. Well, thanks. I appreciate the time today, and I appreciate the questions that I got. I hope I was able to answer them well. Again, I'll mention that please, if you want to follow up, to write to me. My email address again is michael.swack, S-W-A-C-K, @unh.edu. I'd be glad to follow up with anyone on any specific questions that you may have. Great. Anything else that you want to add before we sign off?
Yeah, well, actually, Dr. Swack, I actually had a question that I thought
Sure.
as I was watching this. So you've made a really powerful case, I think, for banks. The CDFIs need banks. Is there a certain time frame, like a certain size of your balance sheet, or a certain space where the opposite becomes true, that the banks are interested in the CDFI? Is there a certain place in the CDFI development where that, that's a good potential next fit for you in the capitalization plan?
Well, the starting point, I think, always is that every CDFI should have a line of credit negotiated, and that's often the best starting point in terms of establishing a relationship with a bank. If your relationship right now is only that you have an account at a local bank, the next step is really sitting down with the bank and negotiating a line of credit. Don't have a lot of time to go into it, but there are variations on lines of credit and what you pay and what are the fees and when would you draw down and what are the terms and conditions on repayment. So there are variables that you want to think of, but every CDFI should have that safety net in place of a line of credit that they can use if they have liquidity concerns. I've seen it as simple as you may get a CDFI a grant from the CDFI fund, but it may not be coming up. You may not be getting the money for another 3 months before it hits your bank account. In the meantime, you may have demands and a loan that you need to close sooner than that and don't have the funds to do it. In that case, a very simple example of how access to a bank line of credit could be really helpful to your organization. So I'd say the starting point in the bank relationship is to look at establishing a line of credit.
Great. That was super interesting. Well, thank you, Dr. Swack, for that wonderful presentation. I couldn't, of course, close a webinar about capitalization without mentioning the fact that OESA does provide capital loans as well as the first-in loans. So that is to say that if you are currently only have equity capital and you are wanting to potentially do your first debt capital and go into leverage, that we are here for you. We're oftentimes the first debt capital that any native CDFI has. So of course, contact us if you are interested in that. And I wanted to thank everyone for participating in the webinar. We will, of course, email you out a copy of the PowerPoint, and we will also have this webinar posted on our website so that you can listen to it again and again for all the great insights that it offers. I also want to let you know that a brief survey should pop up when you close the webinar. Please fill it out. It really helps us track not only this webinar series, but make sure that we're continuing to improve our programs and services and finding relevant information for you all. Also, just to say, our next month's webinar will take place on January 13th at noon Mountain Time, and we will be discussing NACA applications, tips, and strategies. And we're going to get really nitty-gritty there, too, so hopefully that'll help you guys. And we will send out more information on that. So with that, I hope you all have a wonderful day, and we're going to go ahead and sign off.